All right, so there are other forms of penalties as well. I've provided a list here. This is not so much about being able to know what the numbers are, and as a matter of fact, the CPA exam makes it pretty clear that their focus is on situations that create penalties, not the amount of the penalty itself or the percent even of the penalty. So the ones I draw out are the failure to file, failure to pay, the estimated tax one that we walked through, but that we didn't even calculate the penalty notice. What we really did is determine how to make sure you make enough estimated payments, and then to try to avoid the penalties associated with those. So you can definitely read the book because it gives a lot of detail about all these different types of penalties that you can be subject to. All right, so now I want to switch gears a little bit and talk about this Circular 230. I mentioned it early on in the videos, this set of videos, that this covers practice before the IRS. And it says practice before the IRS is limited to CPAs, attorneys, and enrolled agents. There's actually some others like licensed actuaries and people in charge of pension plans that can practice before the IRS. But we're really just going to focus on these, because these three sets are the ones that are probably most important to deal with. In limited situations, other parties may be allowed to practice before the IRS. For example, taxpayer can always represent themselves. Full-time employees can represent their employers, right? So you could be the tax director of a corporation and be represented. You could represent the corporation. Corporations can be represented by their officers, of course, that makes sense. A partnership can be represented by any partner. Trust receiverships, guardianships, estates can be represented by their trustees, receivers, guardians, or administrators or executors. So that's kind of like they're the, the head management of those particular types of entities. And then a taxpayer may be represented by whoever prepared the return for the year in question, but only through the revenue agent level. So they can't necessarily go to court. So there's a limited representation that's permitted there. So the IRS, under Circular 230, the IRS requires that all paid tax return preparers, including CPAs, attorneys, anyone who's preparing taxes for money, obtain a PTIN, a Preparer Tax Identification Number. The IRS uses PTIN data to identify preparers who are committing patterns of errors or who participate in fraudulent actions. So, over time, all tax preparers are bound to make an error. Right, they do. They make mistakes, but when you see a habitual pattern, we used to joke that there was the office where they'd have a file on particular preparers, and they'd stick away a little memo or report that said, "Hey, we noticed this person did this," and then once your file got big enough, they might come after you. But now that there's a PTIN that they can associate you with, it's actually a little bit easier. So Circular 230, which again is a regulation, technically a Treasury reg, governs practice before the IRS, and it says, look, tax practitioners should be competent in matters that involve engagement with the taxpayer. It includes prohibitions against willful or reckless behavior, signing returns that include tax positions that could subject the practitioner to a preparer penalty, and certainly taking a frivolous tax return position, which is one that lacks a reasonable basis. Circular 230 contains requirements to disclose non-frivolous tax return positions that fail the reasonable basis standard. You need to inform clients of penalties that are likely to apply to the extent they're choosing not to conform with the law, and ways that they could conform if they wanted to. You have to make known to clients any errors or omissions that the clients may have made. And you're required to submit records lawfully requested by the IRS. So if the IRS lawfully makes a request for the records, those have to be submitted. Circular 230 also contains requirements to exercise due diligence and to use best practices. So these are a little bit softer, right? So these are more like, hey, this is really what you should be doing, but they're not as strict as the previous requirements. So No unreasonable delay in disposition of matters before the IRS. You shouldn't charge any unconscionable fees for representing a client before the IRS. You, of course, should not represent clients with conflicting interests. So think of that as representing both sides of a divorce, for example. And you're not permitted to charge contingent fees for preparing a return. You may only charge contingent fees when dealing with an audit or amended return. Sorry about that. A little pause to blow my nose. I appear to be coming down with something. I tested for COVID this morning and I'm clear. I'll test again tomorrow morning, see how things are going. 'Tis the season. All right. So California, as I mentioned as well, is one of the few states that regulates tax preparation. This is done through the California Registered Tax Preparer Program. It's commonly referred to as CTEC. So 60 hours, 45 hours of federal, 15 hours of state of education. So you have to get retrained every year. You have to pass a background check. You have to obtain a PTIN because everyone does. And you're required to purchase a $5,000 tax preparer bond. So the bond doesn't cost $5,000, but it can pay up to $5,000 should someone file a claim against you for some sort of recklessness or negligence. You're required to register with CTEC. And of course, there's always a fee, right? Because there's a fee for everything. It's probably more than 33 these days. To renew your registration, right? So that's to get started. Then to renew it, you have to do continuing education of at least 20 hours each year, maintain your PTIN, maintain that bond, and continue to renew your registration with CTEC. So the code also provides penalties to discourage improper actions by tax preparers, right? So that last set of penalties we looked at was really all about payers, taxpayers. So the following individuals are exempt from preparer penalties. So if you're an IRS employee, if you're a volunteer who prepares tax returns with a program like our VITA program right here at San Diego State, if you're an employee preparing a return for the employer, a fiduciary preparing a return for the beneficiary that they're working for, or an individual who provides only data processing, reproduction, or similar assistance in preparing the return, you don't have to worry about preparer penalties per se, right? So if you're an employee preparing a return for the employer, then it's the employer who suffers the penalty, not you as the employee. So you can avoid an underpayment penalty if there is substantial authority that supports the tax return position. So obviously the underpayment stems from the fact that the position taken on the return was wrong. So we're dealing with a tax preparer who signed a return that has an erroneous tax position on it. But if there is substantial authority to support the tax position, in spite of the fact that it's wrong or found to be wrong, or there's a reasonable basis for the position and it's disclosed, the tax practitioner, the tax preparer can avoid penalties. So substantial authority, therefore, is a big deal because if you have it, you can avoid the penalties. So what is substantial authority? Well, it means that you've determined that there's some authority or guidance that says you could take that position in all of these different sources. And if you're in 650, we'll talk about what these are this semester. But these are all things that are published in one way, shape, or form as either part of the statutory, the administrative, or the judicial law of taxes. And generally speaking, all of these are bundled together and published in the Internal Revenue Bulletin. So you can be far more comfortable if something's been published in the IRB that it represents substantial authority. To be clear, conclusions reached in treatises, periodicals, legal opinions or opinions rendered by a tax professional, those are not substantial authority. They are not substantial authority. So there is a preparer penalty for willful and reckless conduct. Applies to any part of the understatement of a taxpayer's liability if it's due to the preparer's willful attempt to understate the tax or a reckless or intentional disregard of the rules is what resulted in that. The penalty is the greater of $5,000 or 75% of the income of the practitioner that is attributable to the return of the claim. There are a number of smaller penalties. I won't read those. Again, these are in the book. You can read through them for yourself. But these are what I would describe as minor penalties for things that have gone wrong. I do want to draw your attention to the last one. So when it comes to individual tax returns, there's a penalty for a failure to be diligent related to what largely we will realize later on the course is refundable credits. Earned income tax credit, child tax credit, other dependent credit, American Opportunities tax credit, or filing under head of household status. So all of those things result in generally a lower tax, and they can be complex or confusing or subject to abuse. And so there's some due diligence that a preparer is required to do, and if they fail to do that, they can be subject to a penalty. There's other parts of the codes that provide additional constraints that govern pretty much anyone who's involved in rendering tax returns to the general public. Obviously, if you claim to have tax expertise but you don't, if you agree to perform a service but then you fail to do so, right? These aren't code penalties per se. These are just things where that makes perfect sense, right? If you prepare tax returns or refund claims for a fee, you have to sign those returns because you're a paid preparer. And obviously criminal penalties can also apply if you're recklessly providing tax advice or tax preparation. So as I also mentioned, the AICPA has 7 statements of tax services. I think rather than go through and read all of these to you, I won't. But I will kind of highlight some of the important parts of some of them. So statement number 1 is about tax return positions. And remember that the code, Internal Revenue Code, under Code Section 6694, says that you have to have substantial authority. Well, the AICPA has a standard as well. And it basically says you need to have a realistic possibility, or you need to feel like you have a realistic possibility of that decision being sustained. And you're required to advise the client of the risks involved. But the reality is this rule basically also says you can't take any positions that are contrary to whatever the jurisdiction's rules are for penalties if they are higher than the AICPA's, right? So in this case, 6694 would apply. It would say, look, you have to have substantial authority or a reasonable basis with disclosure. I think largely those are viewed as being a greater standard than the AICPA. So if you're dealing with a federal jurisdiction, you need to follow that jurisdiction. You got to answer questions on returns. We won't get into that too much. This is fairly important, right? That a CPA may, in good faith, rely without verification on information furnished by a client. So let's say that the client says, oh, I made charitable contributions of $10,000. And that's consistent with other years, and it's consistent with the degree of income that they have. Are you required to actually confirm that they made those charitable contributions? And the answer is no. You may rely in good faith without verification on the information that's provided. If, on the other hand, it would appear to be incorrect, incomplete, or inconsistent, then you must make reasonable inquiries about that information. You can prepare estimates. You can read about those. Knowledge of error, this is a pretty important one. To the extent you've identified an error in a taxpayer's return, you are in fact required to advise the client of that error. It is not to be disclosed to the IRS without the client's consent. If it's material and it's not corrected, you can choose to excuse yourself from the engagement and not prepare this year's return, but you are not required to do so. And then you can read advice for clients on your own as well. Those are all in the book. So I want to talk about privileged communication as the last item we'll discuss out of this chapter. So there's this thing called attorney-client privilege. If you've ever watched any legal shows on television, they talk about it all the time. This means that an attorney and a client can have a privileged discussion, and none of the terms of that discussion ever need to be disclosed to the public or the courts. There is no such thing as accountant-client privilege per se. There is some limited privilege that generally extends to tax advice between a taxpayer and federally authorized tax practitioner. So, for example, attorney, CPA, or EA. That privilege is not available for any matter that involves a criminal charge. It's not available for questions brought by any other agencies, such as the SEC. And it is not available if the matter involves promoting a tax shelter. So it only applies to tax advice for CPAs and EAs. It does not apply to ASC 740 work papers. Maybe you know what that is, maybe you don't. That's the accounting for income tax that's used in financial statements. So obviously financial statements are subject to a different degree because they're generally audited and they're perhaps submitted to a regulatory body like the SEC or the stock exchanges. So that privilege doesn't apply there. And it doesn't apply to anything that should be reported on a tax return. And that brings us to the end of chapters 1 and 26.